Hello, everyone, and welcome to this month's market review for November 2022. We have a couple things that we'd like to go over with you today. Specifically, the overall tenor of the market, and the sentiment seems to be shifting a little bit, at least insofar as the market's rallying throughout October. There were a couple data points that we saw that really helped elevate this. Specifically, we saw the third quarter GDP print a positive result. We also had the Fed meeting here recently that we're going to go over a couple of the highlights there. And then also wanted to touch really quick on the midterm elections and what that generally means for the market. So first of all, we did have a positive print for third quarter GDP at 2.6%. This is obviously a positive, as the first and second quarter of 2022 was negative, and that was primarily a result of all the spending that we did on goods as opposed to services. And what happened during that period of time is we actually saw more imports from other countries coming into our country in the form of goods than we saw exports out of our country into other countries in the form of services. We're generally a services country, and so whenever we're spending a lot more on goods, that means that we're bringing more things into our country from other countries. And the way that GDP is calculated is you kind of aggregate all of the things that we make within our country, and what we export to other countries is a positive to GDP, but then anything that we import from other countries is seen as a negative to GDP. And so what we can see in the results here underneath the surface, we have our 2.6% positive print for GDP, but we had more exports than we had imports for the third quarter. This was opposite of what we had for the first two quarters. So this was the primary reason why we had a positive GDP print for this quarter. The other nice thing that we see here is we're actually seeing consumer spending lessen a little bit. This used to be 1.6% over the last quarter. It has fallen to 1% or just below. This is technically a positive insofar as it relates to inflation, because even though the consumer is continuing to spend through this inflation, they are spending less overall, which should help bring inflation down over a longer period of time. So overall, net positive for GDP print. It's kind of a good thing for a lot of different reasons, and we're hopeful that we'll continue to see expansion in Q4 and then into 2023. The Federal Reserve hiked 75 basis points at their last meeting. This was largely expected, and even though there was a lot of volatility around the speech that Jerome Powell gave after the release, specifically because he was saying that they are going to increase at a slower pace. However, that level at which they eventually terminate their increases may be higher than what the market's expecting. We're interpreting that as quote unquote Fed speak here, because we don't believe Jerome Powell enjoys the fact the market likes to rally on any hint of dovishness in their notes and the way that they're interpreting the economic data. And so our belief is that they will continue to hike at the next meeting, potentially one more hike thereafter. And at that point, they'll wait and become more data dependent before they start to make any further hikes in the Federal Reserve overnight rate. As it stands today, we do believe that the market is set up relatively well to accept these future rate hikes. The volatility within the stock market tends to be concerned with more interest rate sensitive stocks, namely the growth stocks and stocks that have a higher price to earnings ratio. Those tend to be a lot more sensitive to interest rate hikes and moves in the expected interest rate over time. So right now we're comfortable with where we're at, but we do believe that there is more hiking in the future from the Federal Reserve. And finally, the midterm elections. Obviously, this is something that we get a lot of questions on as far as what happens within the elections and how that can be interpreted for the market. And overall, we tend not to see the elections, certainly the midterm elections, impact the market all that much. And what you see here on the slide is how each political party, if they hold the Senate, the House, if the Democrats have total control, if the Republicans have total control, or if it's a split Congress, and what the performance was of the market thereafter. And what you can see on average is there's an 8.3% increase in the market going back to 1946. But what the market really likes to see is a split Congress. And our interpretation is that there's more predictability within Washington whenever you don't have the House and Senate and White House controlled by a single party. if you see that total control here for the Democrats or the Republicans, that's below the long-term average of 8.3%. And so right now, obviously the White House is controlled by Democrats. The Senate and the House are currently expected to be controlled by the Republicans after the midterm election. That would result in a split Congress, which is technically a positive over the long term for the stock market. This is all to say that we don't think that there's going to be a lot of volatility around the midterm elections, regardless of what happens in the elections and their outcomes thereof. So at this point, we're kind of comfortable with where we're at as far as the market's concerned. And then after the midterms, obviously, we're going to be looking to what happens in the general election come 2024. That's all we have for you today. Hopefully you enjoyed this. If you have any questions, please reach out to us and we'll talk to you again soon. Thanks.